Hello and welcome, everyone. I'm so excited to have you in this AIM Summit webinar, Have Central Banks and Policymakers Failed? I'm very excited to be joined by two esteemed guests and economists that are going to be sharing their views on the subject. But before I get into introducing them, just some basic housekeeping matters. We have a live Q&A that will be going on throughout the event. The Q&A session will actually open in the last 20 to 30 minutes of the event, but please feel free to ask your questions as they come into the Q&A on the system, on the Zoom system and the Zoom platform, and we'll be addressing as many of the questions that we get from the audience as we can. It's a sincere pleasure to introduce my dear friend and esteemed colleague, Dr. Ryan Lamont. Dr. Ryan Lamont is the Senior Executive Officer of ADS Investment Solutions, ADSI, and the Global Head of Wealth Management and Asset Management for ADS Securities, based in Abu Dhabi. ADSI focuses on quantitative and systematic investment strategies, as well as bespoke and customized mandates, in addition to state-of-the-art wealth management services. Until 2015, Dr. Ryan was the Senior Advisor and the Head of Risk Management for the Emirates Securities and Commodities Authority, or ESCA, the UAE's federal securities regulator. Previously, Dr. Ryan was the lead portfolio manager of Fortis Investments in Europe, where he was responsible for managing a multi-billion euro portfolio structures, namely in credit derivatives. He holds a PhD summa cum laude in financial econometrics and has taught financial econometrics at several universities in Paris. We're also joined by Dr. John Rutledge, who you can't see on the screen at the moment, but we'll be introducing after a brief keynote by Dr. Ryan, and then we'll have both panelists for the Q&A. Dr. John Rutledge is the Chief Investment Officer and Investment Committee member and Management Committee member of Safanad. He brings a wealth of knowledge and economic insight to the investment committee that has been responsible for guiding the firm's overall investment strategy. Dr. Rutledge has had a long career in private equity investing. He's the founder of Rutledge Capital, a private equity investment firm in the U.S. Middle market, focused on U.S. middle market companies, where he led 30 leveraged buyouts, including Medical Specialties Group, Stairmaster, Adobe Air, Fluid Drive, Serum Corp, and many others. He's advised Fortune 500 CEOs and institutional investors on restructuring, capital management, and investment issues, and has also been an advisor to multiple White House administrations, as well as one of the key advisors and developers of the Reagan Economic Plan. Without further ado, I'd love to hand over to Dr. Ryan to share your keynote presentation on Have Central Banks and Policymakers Failed? Dr. Ryan.
Thank you very much, Zach. I really appreciate the very kind introduction, and I'm delighted to be here. I'll start sharing my presentation. I hope it's visible. So, have central banks and policymakers failed? Let me start with a funny phrase, which my CIO told me today. The Fed in the US basically has done everything except fail. So it's really doing absolutely everything. And you know what? This is one of the problems. I'm going to share just a few statistics and then lots of talk. My talk will be centered around 3 points. The first one is central banks' actions since 2008, so since the international financial crisis. Second, what is happening today? And 3, what does the future hold for us? And no, I do not have a crystal ball. I'm just going to try. So let me start with really some basic stuff. Usually, policymakers, they have 2 potential actions. The first one is monetary policy, and the second one is economic or fiscal policy. Monetary policy is generally adopted when there's a crisis, when there's a shock, when there's something sudden, when there is a slowdown that is really unexpected or expected. The first action that a policymaker makes is use the monetary policy to intervene. Second, when the monetary policy doesn't give any results, then we use economic or fiscal policy. What I'm saying here is not very smart. It's actually basic economics and basic finance that I used to teach in university. So let's look at this slide. This slide basically shows you the Fed rate since 1955 to the current year, 2020, as well as the inflation for the same period. As you can see, it goes up and down. It goes up when there's an expansion in the economy, so the Fed tightens, and when there's a drop in economic activity, then the Fed reduces rates to encourage the economy to start off again. Generally, when the economy is expanding, when we have economic growth, it's very natural to have inflation, which is in the blue line. So you see inflation is going up. You can see it very clearly in the 80s. This is when the Fed rates really spiked a lot and we had lots of inflation. Now, if you look at this whole graph, you'll see there's an outlier there. And it's very clear. It's really today, where we are today. It's this part here. It's very flat. It's a completely flat line. Here you see it much, much better. So here we've had the pre-financial crisis. This is when we had the boom on the financial markets, credit derivatives, we had subprime, we had CLOs, we had CDOs, we had CSOs, we had the credit default swap market completely booming, we had leverage in the system, everyone was buying everything and everyone was making so much money. And then we were hit with the financial crisis. Now, the financial crisis is a financial crisis. The first impact was tightening liquidity. If you remember correctly, the first thing that happened was cash was drying up. It was very scary. There was no cash in the system anymore. So the Fed immediately started its action, reduced rates, and this is when they issued the TARP, the famous TARP, the Troubled Asset Relief Program, whereby the Fed was buying troubled assets. And since then, we've had a complete flat line on the rates. So rates have been close to zero, well, until very recently, until basically 2018 or 2017. Now, we did have inflation. Inflation did go up. However, the Fed kept the rates very low. Now, the problem is that the economic growth was not really very strong. And there was a lot of pressure on the monetary policy makers to keep the rates very low. Now, I'm going to say it, partly it's because of electoral reasons, because basically when you tighten your policy, when you increase rates, you put a little bit of risk to the economic growth that is happening. And it's not very popular because then people will have to borrow at higher rates, they have to pay more, etc. And obviously politicians, they like popular measures so they can get re-elected. So this is not really specific to the US, it's really general around the world. Now, we've had these completely flat rates. Now, this is a problem. Why? Because when you keep the rates so low, you're having the market get used to a normal. And these flat, very low rates close to zero have become a new normal. So the market got used to it. The market got flushed with cash completely. And this cash went to financial markets, it went to stock markets. It didn't go to the consumer, it didn't go really to the end user. Most of it went to the financial markets. It became very cheap to borrow, so you could just borrow and buy stocks. Companies could just borrow and buy their own stocks. They do share buybacks. So everything got flushed into the financial markets. And this is where we've seen this tremendous rally on the financial markets. Now, let's look at unemployment rates. Unemployment rates, 2005 to 2020, we have this peak during the financial crisis, and then the job market started to recover very slowly until we reach quasi full employment. We were at the natural rate of unemployment, the long-term one, around 3.5 or 3.7%. And then everything, absolutely everything got lost in the past 2 or 3 months. As you can see, unemployment completely spiked. Now, if you look at the financial markets, if you look at the money markets, if you look at the cash market, there was no disruption there. There was no problem. No one was short on cash. There was no rush to cash. It's not a monetary problem. What happened is more of an economic problem. It is not a financial problem. So the Fed, the central banks around the world, they continued at the same pace, which is extraordinary quantitative easing, money printing, flushing the markets with cash, just to prevent a monetary squeeze, though it was not the risk. Rates are flat at zero, and we have structurally low inflation. Now, again, as an economist, this is problematic. Let me go back to what I said initially. When monetary policy doesn't work, you switch into economic policy. You switch into fiscal policy. You do not keep pumping cash, printing cash, and using monetary policy, because this doesn't create inflation. Everyone was waiting for the inflation. The Fed was waiting for inflation. Did we get inflation? No. What we got was asset price inflation, and this got reflected into the stock markets. Now, zero rates or negative rates, if they worked, had they worked, Japan would have grown at 10% per year in the 90s. Germany over the past 2 or 3 years and other European countries should have grown at 5 and 7% per year. But no, when you reach 1% or lower of rates, then that's it. You have to call it. Your monetary policy is not working. You have to switch into the unpopular economic and fiscal measures. And this is unavoidable. What we got into is not anymore capitalism. The market got completely distorted. Today, if you look at the financial markets, and specifically the fixed income market, it's completely distorted. Usually we as professional investors, we seek signals from the fixed income market in order to see which way we're going to go. We look at the yield curve. We look at so many of these things that are today distorted because of this quantitative easing. Now, let's look at inflation. Why didn't we get inflation? Again, let's go back to the basics. You have two types of inflation. The first one is the demand side, and the second one is the supply side. The demand side inflation happens when you have a sudden jump in population, when you have a sudden increase in employment, when you have a sudden increase in wages. Now, we've had these happen over the past years, but we didn't get any inflation. Supply side inflation comes when you have an increase in prices of factors of reduction or increase in energy prices. So for example, when you are at almost full employment, like in the US, in order for you to hire someone, you'll have to pay up. You'll have to give him an increase in salary versus his current employment so you can hire him. So hiring someone becomes more and more expensive. And this is when one of the factors of production, which is employment, becomes more expensive. Oil was not cheap, but still we did not get any supply side inflation. Inflation remained in check over the past few years. Now, why didn't we get inflation? Today, and this is something I've been talking about since 2016, in my humble opinion as an economist, inflation will not come back to the same levels that we've seen before. Today, again, inflation comes when you have something unexpected, a spike of either demand or supply or both. Today, if you look at how the retail sector has transformed, you have Amazon, you have Alibaba, you have Walmart and others. The supply chain today is so optimized that the suppliers can adjust their supply extremely quickly to demand. Everything is done online using real-time inventory measures, using real-time measures of demand. So today we do not have these gaps we used to observe previously between supply and demand that used to create inflation. So today inflation, given everything electronic today, whereby supply and demand are adjusting extremely quickly, quantities versus prices, it's very difficult to get the same inflation we used to get. Most of the inflation we're seeing today is coming from population growth. And that is why we're not seeing the 3%, 4% or 5% inflation we used to see before. Again, this is my own theory. Now, where did all of this inflation go? As I mentioned, it came into the financial markets. Look at the S&P 500, 2005, 2020. It's just the perfect rally with a few interruptions there. So all of this cash went into the financial markets. Now, one thing to note is on the lower side of this graph, if you look at the first half of the graph, these are the volumes. The volumes pre the crisis, the financial crisis of 2008, the average was 1.5 billion. However, today, you see the average volume is the 0.5 billion. So we have today 30% volume of what we've had previously. So it's, yes, the financial markets have grown rather quickly using all of the cash flushed in the system, but at lower volumes. Now, what's happening today? Today, the Fed has its back to the wall. It has kept the rates so low for so long that now doesn't have any tools anymore apart from printing dollars, which is quantitative easing and in financial engineering. Extraordinary measures have taken place without having seen any credit crunch. It's unlike 2008. What we're living today is an economic crisis. The economy has been put at a halt because of the coronavirus. There is no financial or credit crunch at this time. The Fed is not intervening anymore, in our opinion. It is interfering in financial markets. When you buy ETFs and bonds, you're distorting the markets. You're confusing professional investors. So today, as I said previously, institutional investors are not getting the same signals they used to get to take their investment decisions. As for inflation, given where we are today, we're not going to see it anytime soon. It will remain pretty much in check. Now, for the future, when you halt an economy, and the economy has halted because of the virus, the economy cannot be restarted by flicking a switch. An economy takes months, if not years, to restart when you halt it. And that is why we are headed to a severe recession and potentially a depression. You know what? This is not so bad. As an economist, I believe in economic growth and recessions. They are both extremely important. Recessions are not a bad thing to the economy. They're actually a very good thing. It's the yin and the yang of the economy. When you have a recession, bad companies go bankrupt. You flush out bad companies. Second, you expose Ponzi schemes. You expose frauds. When the tide is down, this is when you see who's swimming naked, right? This is the saying. Recessions are very important to clean up the economy. We have not had a recession or even economic slowdown because the central banks and policymakers were so busy suppressing them. So we did not have this cleanup that is very important that the recessions create. Three, we're going to have new sectors created. We're going to have what used to be a passive sector become an active sector today. And finally, and most importantly, creativity and innovation and resilience. Recessions, depressions, economic difficulties are what push humans to create and innovate. Without them, we as humans, we became complacent, we become lazy. And this is what we've become over the past few years. We need recessions, we need hardship, because hardship is what keeps humans at their edge. It's what keeps them innovative. It's what keeps them creating financial solutions, technology, etc., etc. Thank you very much. These are my 2 cents for now.
Wow, well, thank you, Dr. Ryan. That was an excellent presentation, and I see a lot of really interesting questions coming in that I'm excited to get to in the Q&A session. But Dr. Rutledge has also joined us, and will also be giving a short keynote discussion before we kick off the Q&A. Dr. Rutledge, before you joined, I had the pleasure of already giving an introduction to you, so I'll just hand straight over to you to share with us your presentation on Have Central Banks and Policymakers Failed?
Okay.
Thank you, Dr. Rutledge.
Bear with me 1 minute. I'm getting my PowerPoint file screen shared for you. And I think that should do it. Do we have slides now?
We have slides.
Excellent, excellent. Well, thank you very much. And I really appreciate your remarks to start this off as well. This is a tricky time. And I think that maybe the best thing I can do for you is to try and give you a couple of ideas that you can use to test facts against when they pop up. Because we're all seeing the same newspapers. We're all seeing the same thing happening in the real world. My motto is always to go back to Leonardo da Vinci's answer when someone asked him, what's the secret to making your sculpture? What's the secret to making a great painting? He said, the secret is to know how to see, saper vedere in Tuscan. And knowing how to see is really to see where you want to go. So the The ideas I want to leave with you today is two sorts of ideas. One is what's happening in the world. Next is how to think about it. What's happening is this is not a recession. Recession is a buzzword or a jargon word used by economists for normal times. This is not a normal time. This is a shutdown. And the shutdown is something not too different than happens every Friday in the Middle East or every Sunday in the West. It's just that it's lasting a lot longer. Whether it's very important or not so important will depend on whether firms die while the shutdown is happening. Like all the other crises, this one will end too one day, and when it does, the ones that have survived it will have extraordinary opportunities to invest and grow businesses. And you know what? This is not my first crisis, and it won't be our last crisis. I've been studying for many years a topic in the physical sciences called complex systems. Complex systems and network theory are the mathematics behind the idea that networks like the economy crash from time to time. And when they crash, everyone's surprised. And then over a certain period, they regrow again. It's the network of the market that has crashed. So I want to give you a little framework to think about that. Most important thing for you today to remember is there are two different kinds of change. One is the kind of change most economists talk about, where you're near equilibrium, something nudges you away, and then you gradually find your way back. We call that arbitrage. The second kind of change is violent, radical, surprising change that happens in far from equilibrium events, and it causes temporary system failures. We are in the second kind of change right now. What's called modern macroeconomics has nothing to do with that kind of change, which is why it fails to explain it. So what I want to end up with is talking with you about a two-part business strategy or investment strategy. One is what you do during more normal times, and the second is how do you protect yourself against these crises, or right now, take advantage of the opportunities created them. And the thing I want you to remember is that almost all the changes we see in our lives are small, but all the change is dominated by those few large changes, these far from equilibrium events that dominate our lives when they happen, just like the coronavirus. So why are we having trouble understanding this? To first approximation, anything that calls itself modern is a hoax. Modern macroeconomics, modern portfolio theory, and modern monetary theory. Those are all attempts to give yourself credibility for ideas that aren't working. There are fatal flaws in modern macroeconomics. Achilles had one dangerous heel. Macroeconomics has two. The first one is that it's completely fixated on GDP or product flows, and it ignores the balance sheet of the economy, where all crises erupt. The second is it assumes the economy is always at or near equilibrium, but that is true most of the time, but not now. And about once every 5 or 10 years, we get shocked by one of these events. The reason they don't understand that is that they build their models from what's called a representative agent, which means they study carefully the behavior of one person, and then they just pretend there are 350 million of that person in the economy, which means a person is very smart, has no emotions, and the people don't interact at all. Well, if you've tried to buy products in the supermarket lately, you'll know that the interactions are where everything is. If everyone weren't shopping and emptying the shelves, you wouldn't have to rush there and empty the shelves yourself. So it's the interaction that causes financial crises. Real world doesn't work like those theories. When big events occur in the asset markets, they completely dominate GDP, and it's the interactions that are the most important. The market crashes, which are called cascading network failures in the network theory literature, are like avalanches. Some of them are small and some of them are large. The large ones are the ones I want to talk about. Now, to our first Achilles heel. Every macro book I know says there's an island economy. Some people pick coconuts, some people catch fish, add them together, and you get GDP. If you do that for the US, we now have about a $21 trillion per year GDP. But that GDP is dwarfed by the capital base of the US. We have $356 trillion of assets at market value in the US. The net worth is only about $110 trillion because many of those assets have offsetting liabilities. So a bond has an owner and an issuer. But 356 trillion is the size of the asset market that can do damage. Just to describe it for you, it's about 70% paper and 30% houses and boats and cars and buildings and other real assets. In 1981, when I was first working in the White House and inflation was 15%, that was 50%, 50%. So since then, an enormous amount of money has moved from real assets into securities, which is why we've had this tremendous boom in bond and stock markets. Some of that's government debt and some of it's private. 22 trillion before this year. My estimate is by the end of this year, we will have seen something like $8 trillion of new budget deficit for the year, which means we'll end up something more like 30 trillion at the end of the year, larger than GDP. What really matters for the asset markets is whether people want to own the ones they owned yesterday. If they don't, the prices fall. If they do, the prices rise. Most important concept for you was a shock when I first learned it. The Earth is 8,000 miles across, or 12,000 kilometers across, 13,000 kilometers. Only 4 miles thick is the crust that we stand on. At its thickest, under the Himalaya mountains, it's 50 miles thick. Underneath that is a churning liquid of lava that continually moving. It's an illusion that we're standing on a stable planet in the first place. So just like people in Japan expect 3,000 earthquakes a year, we should expect these tsunamis or avalanches of financial markets when they happen too, and we should prepare for them. The way you prepare is to understand the difference between these two kinds of change: gentle change and violent change, near equilibrium and far equilibrium. The theory behind that's very simple. If you have two closed systems that don't communicate, they'll stay that way for a long time. But if you open a communication, just like the water in these two giant tubs, then water begins to move from high pressure to low pressure system. It stops when it reaches equilibrium again, when there's no further motion. If I apply that idea to economics, first of all, I apply it to capital goods. Most of the capital goods in the world are in the US, Japan, and the EU. China and India have per capita much less, which means that the prices and the rates of return are vastly different. And that means capital moves. Capital flows from the Western countries to the Eastern countries, because that's arbitraging those relative returns. If I take the same thing and look at it from the point of view of people, China and India have people, we don't. So people are leaking in or being arbitraged into the US, Japan, and the EU. How does that happen? It happens through immigration, legal and illegal. It also happens through imports, when you're importing people's labor on a boat. It also happens now on optical fiber when you import services. Nevertheless, that's driving those rates of return on capital together. When that's slow, it's smooth. But when it goes faster, like through optical fiber, it develops turbulence. As you can see in this bottom of this chart, turbulence in politics is terrorism and conflict, and protectionism. In economics, it's financial crisis and recession and depression. So far from equilibrium economics is actually not a new idea. There have been Nobel Prizes issued in this, but in physics, chemistry, and biology, it's only new in economics. And financial crises are really phase transitions between two different states of the world. One state where everything's working, called that general equilibrium. It's what the macro books write about. The second state is where the network has failed and people are trying to scramble as well as they can, like we're doing today. An economy can remain in that alternative state for quite a long time. An investment strategy or a business strategy has to have a strategy for both of those states and for the transitions between them. So I'm going to show you some pictures of how to think about that. Economics books all talk about the production function, where you put capital in and you get production out. So production function relates inputs and outputs. Using that and talking about the fact that capital and labor both grow over time, you end up with a time series for potential output, which means if we're at full employment, that'll be the amount of GDP that can get produced by the economy over time. Full employment grows because of capital formation, because of population growth, of course. When we have a recession, economists call it a gap, an output gap, which means the economy is producing less than it could. They think that it's somehow not delivering at its potential. The fact is, it's living in a different world. That other world is a second state. I'd like you to think about two production functions. The first one on the top is really what the economists talk about based on maximum given capital and labor. The second one down below is the maximum output you can get with failed networks. Now, what I mean by failed networks, when credit markets won't allow you to borrow money at the posted rates, but they engage in non-price rationing, that is a failed network. When there's rationing happening of anything, it's a failed network, so market failure. This is what happens during a crisis. We're going along at full employment for a while, which is the black part of this, along potential output, and then we reach a certain point. In the physics literature, that's called the critical point, or criticality. The critical point is when the next little nudge would push this thing into a system failure. That system failure, which is A to B on this diagram, is what we live through from March through a lot of this year. After the system has failed, markets are not working well, so we live in a recession state or a lower output state for a while. And then finally, networks begin to regrow as people develop confidence, and you get back to potential output again. So if I take those four zones and I talk about that from the physics literature, I see that the first state is the state of the world where everything's working. Friedrich von Hayek would be proud of that world. That's the market economy at its best. The second state is a phase transition between working and broken. And that cascading network failure is when was the stock market during March, or the credit market's actually starting right now. Once the market has failed, it can crawl along in that suboptimal state for a long time of a failed network, but sooner or later, people begin to have confidence again. If I apply that framework to the subprime debt crisis, I find out that the years until 2007 were that full employment state when everyone gets excited. And then we had a crash. That crash ended in March 2009, March 9th, I believe. Crashes are very fast. And then we lived in a failed network state for quite a long time, for about 2 years. The transition back to full employment began in 2011 until the latest crisis began in 2020. So if I take that and I apply it and I look at what happened in the markets and in the economy, I can see that during that full employment state, which lasted about 3 years, the economy grew 5% a year. It was tremendous. Jobs grew, but the returns, well, they were okay over that 3-year period, but they weren't outstanding over that cumulative over that 3-year period. Cash yielded 4, bonds 7, S&P 27. 27 divided by 3 years is actually 9% a year. Not too exciting. The crash took all those returns big into negative territory, whether it's stocks, bonds, cash, or real estate. You lost you lost money except for the treasuries. During the recession, strangely enough, is when you make huge returns. The returns from the crash up to the next recovery are almost triple your money in hotels, double your money in industrial and retail and office and multifamily commercial properties. 45% increase in the S&P and a 23% increase in the bonds. That's a great time. But the next time is when you really make a killing. The recovery after the network starts to reform again, which was 2011 until last year. That's the time when everyone gets too excited. So if I apply that to this period and I look at Morgan Stanley's scenario of how this thing will come back together again, I can take that timeline, put it in this framework, and end up with the following chart. It says and this talks about what you should do in each of those phases. in the state one, full employment, that's when you should be selling your companies. That's when you should be raising cash and selling your best performing stocks. That critical point was actually late last year. We could see that in a number of ways. WeWorks was one way of seeing it, where the markets went crazy, the venture capital market went crazy. Another was terms in the private equity community, where auctions got shorter. You had less time with managers. You could not visit businesses. They needed quick bids on companies. Things at that point were looking silly. You need to have already raised cash when you got there, because you have to hold cash during the big drop period, the phase transition, which is right now. So you have the cash when you get to this period of state two, where the best investment strategy is distressed assets from forced sellers. Now, I just spent 2 hours on the phone with our investment team, and the distressed asset markets has now raised a lot of money, but there's not a lot of distressed assets happening just yet, because the sellers don't sell distressed assets until they're forced to do so. That won't happen until later this year, but there will be huge bargains in buying the debt to take over the equity of companies that got in financial trouble. The ups, the period from C to D, phase transition, is when you need to have already identified and purchased the high quality assets that you want to ride back up to full employment. They need to be companies that can increase their sales with big gross margins, with low debt, and with a lot of cash. Time for doing that is over the next 2 years, at which point you'll be back where we started again, and it'll be boring again. But with that in mind, I think where we are right now is right in the middle of this period of the phase transition. So what does that mean for policy? Unfortunately, policy is designed by the people on the Federal Reserve Board. Now, I know many of the people on the Federal Reserve Board because they're my contemporaries in the economics business. They all learned their macroeconomics from the same half a dozen guys, all of whom are fervent religious believers in general equilibrium and full employment. Those people don't have a clue how to understand a market crash or a cascading network failure. Those people were scared to death when this happened, and they're throwing money at it. Now, as the previous speaker said, where does that money go? It does not go to the GDP accounts. To a first approximation, the only thing the Fed controls is its balance sheet. And the only thing that changes is asset prices. So the split between high income and low income everybody talks about isn't that at all. It's the split between asset owners and workers. That split in futures and net worth is going to be driven wider and wider and wider by this. And the political fighting that we've seen until very recently, and is happening now across the world, is going to get much worse because of it. So I really think that the stimulus they've done is really for the wrong reasons. I think it'll show up in asset prices. It's too early for it to be showing up in the credit markets or in private equity or in real estate. Some of it's showed up in the best companies in the stock market already, but there are other companies that have been left behind. Value companies, real estate trusts, and so forth. So I wouldn't be too excited about the stock market right now. I want to now harvest some of the cash that I've made over the last couple of months in this rising market and hold that in reserve against the advantage or the opportunities I'll have later this year and next year to buy things at half price. And so let me stop there and see if you have any questions, Zachary, that you want to talk about, or we can have a dialogue.
Great, thank you, Dr. Rutledge. So we have a lot of questions from the audience for both you and Dr. Ryan, and this is probably going to be a question for both of you. But I'd like to start with Dr. Ryan. Both of you touched upon this point. So Dr. Ryan, you discussed about the importance of economic recessions for a healthy economy and flushing out bad companies. Now, with the Federal Reserve and policymakers have entered into unprecedented stimulus programs and are even going so far as to buying junk bonds. One of the concerns raised by Sabah Al-Banali, who's asked a question from here in the UAE, is in terms of flushing out bad companies, is all of this stimulus, and do we not run the risk with these kind of accommodative policies of now having zombie companies? And what are the potential investment risks and risks that we have on the economy for having these zombie companies, if that's the case?
Well, yes, that's a very valid question. Thank you very much for the question, Sabah. Given the past 10 years that we have lived, yes, this could lead to zombie companies, unfortunately. It has been a completely twisted situation over the past 10 years. And the result of it is the growth of certain companies that shouldn't have grown so much. It's money coming from investors that shouldn't have put money in such companies, because when you look at all of the asset classes over the past few years, everything has gone up, everything. Last year, whatever you bought, you would have made money, really, whatever. So as an institutional professional investor, you become a little bit lazy in financial analysis and due diligence. You tend to put money in companies that don't deserve it much easier than you should. And yes, the result is very bad, is having zombie companies. Now, I hope that this recession will be tough enough to take away these zombie companies, so we can really start afresh when the economy starts expanding. It's really to flush out as many of these as possible, so we can really start on solid ground later on. I know this is very harsh to say. Many people will lose their jobs, and you know what? Losing a job sometimes is very bad. It's psychologically impactful on the person. But many of the people who are going to lose their jobs now, they're going to become entrepreneurs. Many of them will create companies. Some of them will create very successful companies. And a minority of these will get financing from good investors. And some of these companies will grow into amazing companies in the future. So yes, it's bad. It's psychologically taxing, but it's very important for the economy.
And Dr. Rutledge, if you could potentially expand on this, and also touch further on the fact that you discussed how a lot of the stimulus is not being allocated to the right places. It's hard getting it into the right hands. A lot of it's going into the hands of parties that don't need it, and others are being starved for capital. Some of the challenges have been, for example, in the United States, the implementation of this for small businesses. And we've already started to see examples of these issues. 2 days ago, it was announced that a reality TV star spent funds from the small business program on jewelry and on a Rolls Royce. So what are some of the issues that you're seeing in implementing this, and how have policymakers failed in implementation of this program to get money where it actually is needed and away from where it isn't?
There we go. I had to unmute myself. Good question. First of all, Dr. Ryan, I think that the language of creative destruction is apt and very important, but is something that in many circles today I wouldn't want to talk about out loud, because there's a lot of pain out there on Main Street. What I do know is that the people who are making policy today do not understand that idea at all. You have two groups of people. One group you can think of as some of the White House players, old friends of mine, who are really supply side guys. And supply siders think that we should do whatever it takes to make the maximum GDP and incomes for the economy. And that makes them always want to do stimulus. So they've been pushing the Fed and Congress to do what they've been doing. In private dialogue with them, I've been saying, you know, if you understand the ideas that I gave you earlier today, the best supply side policy would be one that wouldn't make these big ups and crashes happen. because the crashes cause a lot more damage than the reduction in the growth rate if you didn't get into the bubble period. So my way of doing policy would be to avoid the bubbles as much as possible in the first place by having a more sensible monetary policy. Your point, Zachary, about the wrong people is really right. You know, some of it is politics. That is, some of the people who got money are, you know, in the Clinton days, we talked about friends of Bill. Well, now we have friends of Don and others who have had their, who've gotten enormous amounts of cash from the stimulus programs. So let's face it, all of us who own assets have gotten money from the stimulus programs too. And we're not the ones who need it. The ones who need it are the people who are earning money by the hour with a weekly paycheck who are not getting paid right now. And unfortunately, some of that is not politics. It's just the way the economy is structured. There's really no efficient way to push money from the federal government to the people. The whole system is designed in reverse, to collect taxes from people. So when they when they get into the days when they want to distribute helicopter money to people, they try and push it through the Fed, through the banks, and the banks block it up and use it for their own mercenary purposes. You would be better off to actually use helicopter money and drop it on people in working districts and let them have the money. But the fact is, the money's going in the wrong hands. The programs have not gotten it where it needs to be. Small business is where the real pain is. Small business has no orderly way to get funds. The SBA is too slow. The IRS is not designed to pass money back to people. And the small businesses in general are not big asset owners. If you want one little glimmer of hope, the Manheim Index publishes used car prices on almost 300 million used cars. And a new number came out yesterday. For the first 2 weeks of May, that number actually is up. It was a big drop last month, but it's firmed up this month, which means there's some amount of liquidity that's gotten itself down to people's driveways. And so that's a little bit of good news, but I think most of the news is not so good out on Main Street, and it's going to be a painful time ahead for people. And how you respond to that, it depends on whether you have your asset owner hat on or your worker hat on. Because right now, everything you learned in business school is wrong. I was talking to a person running a business last week, and they said, well, you know, we now can't employ these people anymore because we're laying them off because they're not critical to our business. I said, well, that's how they taught you to think in business school. Right now, you should just be thinking about whether you can afford to keep paying them or not. So if you got money from the government and your customer is not there, and you're still able to pay those people, you should be paying them to get through this tough period. So normal rules of thumb aren't really working very well right now, and you have to be thinking more about the interactions between people, about the society as a whole, and to make our way forward with this.
Thank you, Dr. Rutledge. A question for Dr. Ryan from Nabil Nazar. You mentioned that you're not concerned about inflation, yet with the US leading a global decoupling drive, won't that lead to higher cost of production and hence inflation at some point?
I do not see it anytime very soon. When you have the US looking down literally a cliff whereby the US might lose 30% of its GDP and go in excess of 20% unemployment, this is when people are not buying anymore. So where would inflation come from? I see that very difficult to happen. No.
And Dr. Rutledge, what would be your opinion on, we've talked about asset prices, but consumer prices, and also actually, for the sake of discussion, also commodity prices in the future. Do you see inflation in consumer prices or commodity prices on the horizon, or would you be would share similar sentiment to Dr. Ryan?
I think this is a time when we have to drop our traditional jargon when we're talking about these issues. Inflation to most people means the consumer price index. The consumer price index is actually 70% services, haircuts, guitar lessons, and so forth, not physical goods. And so the prices of physical goods aren't the most important driver, it's the price of services. Productivity growth in services and in technology has made that number very weak and very low. But every good, every service, and every asset has a price. And so if I'm saying, where's the inflation is in the asset prices. The balance sheet has a price level and an inflation rate too, and that inflation rate is very high at the moment. That's the inflation rate that matters for people's decisions about which kinds of assets to own, arbitrage, asset allocation decisions. So the CPI is important, but it's of more political importance than it is of economic importance, and it doesn't drive capital spending. And I'm convinced, as Dr. Ryan is, that the asset markets is where you'll see the prices rise. And I want to have bets on high productivity growth companies who continue decreasing their prices on the other side. So Alibaba and Amazon are obviously two of those.
A question from Sanjeev Taneja. How does the current crisis impact institutional investors like family offices, pension funds, sovereign wealth funds? I know both of you work very closely with such organizations. Again, we've recently seen SoftBank declaring a loss of over $15 billion, directly impacting a number of sovereign wealth fund investors, including some here in the region where Dr. Ryan and I are based. Would a fund offering with a principal protection fare well with decoupling of this from recent ROI? So I guess, again, the main question is, how does this look for institutional investors, family offices that you're working with, this crisis? How is it impacting them, and what are they doing to address it?
Yeah, after you, Dr.
Thank you. Well, basically at ADS Investment Solutions, we started advising our clients since last year to book some of the profits they had made on the financial markets. It's been a tremendous few years that they had, whereby they made really lots of money. So it was time really to book some profits, sit on some cash. Now, going forward, and these clients are institutional clients, going forward, this cash portion could go into really what we call stock picking, bargain hunting, and there are many at the moment. Dr. John has alluded to that. Some of these companies, for example, you have, without naming, you have a company in Germany, a listed company, a large one, that manufactures ventilators and oxygen masks. The stock price of this company has gone up 60% year to date, has benefited a lot. You have lots of these companies that are no-brainer to invest in. So some of this cash that some of these institutional investors are sitting on could go to these stock picking or bargain opportunities. The new sectors that will emerge, for example, the resilience sector, this is something to invest in. There are certain private equity investments today that make sense. What I'm alluding to is that many of these institutional professional investors should look at their asset allocation and change it, because the asset allocation that worked until 3 or 4 months ago will not work over the next 3 years. We're not talking about 3 months. We're not talking about 6 months. We're talking about at least 3 years. And these institutional investors are expected to change this allocation.
So Dr. Rutledge, we only have a few minutes left, so I'm actually going to go to a different question for you. From Admar Moise, aren't there other ways to stimulate through fiscal policy while increasing productivity, such as national Fed programs that could create millions of jobs, such as the Recovery and Reinvestment Act that was implemented after 2008? And why are we not seeing more happen in national programs that can create jobs directly?
That's an interesting question. I think probably because they're not fast enough and broad scale enough to appeal to the political need of the moment. The best example of what you're describing is what China did after 2008. They had a tremendous stimulus, but they put it all through infrastructure spending to the economy, which built roads and railroads and subways that raised productivity for later when people got back to work again. That's something like the US did in the 1930s with the WPA and the public works projects. But that is much too cumbersome to find its way through Congress in scale enough to matter in the short term. And politics is a very short-term business. So I don't think that it really has much, it's not where you're going to see the big money in the stimulus programs. I do think long-term, the biggest solution to what, the biggest way of helping what you're talking about is educating children. The one positive that's happened is people have figured out that you can do online education now. And online education is the way to bring people into the educated workforce that never had a chance to be in it before. That's the best productivity enhancer I know. That'll happen where it can do the most good, which means in lower income emerging market countries, and thank goodness for that. We really need that. The one idea we haven't talked about is the fact that people get so angry during these crises that they look for somebody to blame. And right now, the US government is helping people blame China for every problem that we have. The US and China damage that's been done by this crisis won't be repaired in the rest of our lifetimes. It's a tragedy because it took 40 years to get to this point where we were actually beginning to trust each other and do business. The blame's on both sides, but between the trade war and the coronavirus spats that have been happening, it's very ugly. And I think in the future, people in other parts of the world are going to be forced to try and choose between one of those two large partners in deals. And I think that they should refuse the choice and they should insist on doing business with both of them. Because the world is not going to be dominated by one country. The world is going to have the US and China as the giant countries. And for an investor, that means I want to own some Chinese positions just as I want to own some American positions over the next 40, 50 years, because that's where almost all the income growth is happening.
So, Dr. John, Dr. Ryan, both of you have given an excellent overview of the economy and how policymakers have failed. Two of the points that you touched upon, both of you have touched upon, and that you were just touching upon there, Dr. John, and something that I'd like to ask you each to elaborate on as part of your closing remarks, and any other points that you'd like to cover that you feel that we haven't covered. But for me, the thing that keeps me up at night and how policymakers have failed and is about the long-term consequences that we're going to be facing from this crisis. And we touched upon, again, how some of these solutions were not politically viable because politicians were looking for the short fix. But it, again, was not so long ago that the key political issue was increasing levels of populism and increasing income disparities. So really, these are the two key issues that I'm concerned about as the long-term consequences where policymakers have failed, and we are going to be living with these consequences, I believe, long after the bottom of this crisis hits and long after the recovery is completed, are basically how this response has widened the gap. How this response has widened the gap between the asset owners, the capital owners, and the laborers. The working population, the average Joe, the separation of the Wall Street and Main Street, which has been a key political issue over the past decade since the last crisis. This has only widened, it's only become worse, and it's getting to the point of breaking. Political systems around the world are already strained significantly by these issues. The second is exactly the concern about the US and China relations. We are making, the US policymakers are making a lot of noises that were made, after the First World War, which led to the Second World War in terms of paying reparations and again certain things that are demonstrating the inconsistent fraying of the U.S.-China relation. So I was hoping that if each of you could touch upon these issues. Should I sleep well at night? Are these the issues to be worried about? What else do I need to be worried about in the long term on how policymakers have failed and the consequences that we're going to be living with? Dr. Ryan, if you could go first. Thank you.
Do we have another hour so I can answer this? I'm going to answer very briefly. On the first point, I'm not very worried. I think what's coming upon us is going to be very hard. It is a recession, potentially depression. Yes, the gap will be increased. Yes, there'll be a disparity between the two. This is problematic. However, no, it wouldn't keep me up at night. It's part of finance and economics. The market will adjust, the economy will adjust. Now, over the much longer term, I do expect to see more of a decentralized monetary authority with the transformation into digital currencies. We are headed there, and we will get there. We will not have central banks anymore, and I hope we won't anymore. On your second point, which is more political, yes, this keeps me up at night. Yes, I am worried about it. The tension that Dr. John has alluded to and that you spoke about as well is very worrisome. It's the potential divide of the world between what we have seen previously, a communist world and a capitalistic world. I hope that we're not headed into today a Chinese world versus a US-driven world, because this would really be a catastrophe for the world. We cannot take another one of these anymore, neither economically or politically.
I'll take a stab at that also, Zachary. I think those may be the two really important issues, not for the next 6 months, but for the next 20 years. The income disparity, which is really a net worth disparity, is only going to get much worse. And every time we have a crisis, if we throw money at the asset markets, it'll get even more so. The great irony is that's what, after 2008, that's what created the political turmoil that elected President Trump. And President Trump has a government that actually has a cabinet full of hedge fund managers. So it isn't the worker on the street that's represented in the cabinet, it's Wall Street that's represented in the cabinet. I think that's always the case, that's always going to happen. And I think that problem is going to get much worse, and I don't see anything turning it around near term. You'll definitely see reaction. The reaction will mean higher tax rates. Whether it's in 2 years or 3 years or 5 years, these are probably the lowest tax rates you'll see in your life, which means planning around those tax rates for investors is very, very, very important right now. On the US-China, I put a lot of personal energy into the US-China story over the last 20 years, and it's very disappointing to see the way it's gone. Recently, we even saw a balloon floated out of the White House that they're thinking about defaulting on part of the US debt. You don't default on part of a security issue, you default on trust. And that kind of thing is just insane. I'm hoping that that idea goes nowhere because whether China owns the bonds, Japan owns the bonds, or your grandmother owns the bonds, they have the complete faith and trust of the government behind them, and you cannot touch that no matter what you do in any other area. So I think so far we've seen this not stopping China's growth. China still has income growth. It's not going to stop the money that they're spending on trying to push their political influence, which is the One Belt, One Road program. It is, however, going to bring China and the US to a clash. Now, whether that clash is words or deeds still remains to be seen. So far, it's mostly been words, and I've got my fingers crossed that it works out better than that. The biggest worry I have is that hating China is so politically popular in America today that now you're seeing the Democrats trying to compete against the Republicans for who hates China most, because they want to win elections too. So this is a very bad dynamic for the future. But I guess I have hope, because we need these countries working together for your children and my children to have a future. And so fingers crossed that this works out better than we're fearing it will.
Well, thank you both so much. We really covered so much ground in so little time. I cannot thank you enough for excellent presentations. I'd like to thank you on behalf of the audience. I'd like to apologize to the audience. There's so many good questions here. There are 20 questions that I didn't get a chance to address. There were several that I did. So I'm so sorry for not being able to cover all the questions that we had in this limited amount of time. But I'd like to, again, thank Dr. Ryan, Dr. John for taking the time, for giving this presentation, and hopefully we'll be able to follow up with some of the questions that people asked after the call. So also, again, wanted to invite everyone. There are webinars planned on some of the topics that we discussed in this call coming up in the next couple of weeks. So if you're looking for more, there will be more to come. Dr. Ryan touched upon the future of digital currencies and that we may not have central banks in the future. So we have Mike Novogratz, the CEO and chairman of Galaxy Digital and the former president of Fortress Investments, coming on June 10th. 5 p.m. UAE time, along with Dan Morehead, the CEO and founder of Pantera Capital, one of the largest crypto funds in the world, to discuss with us, is this the time for Bitcoin and for digital currencies? Also coming up on June 1st, we have a real estate investment in the post-COVID world. It's going to be happening at 4 p.m. UAE time with Ian Russ and Jay Huang, with sovereign wealth experience and significant experience investing globally in real estate. We're going to be discussing how to invest in real estate in the post-COVID world and the future of real estate in COVID. So I'm so excited to host those webinars with you. I hope you'll be able to join us. Again, thank you so much to everyone for dialing in. Thank you so much to Dr. Ryan, to Dr. Rutledge. There are lots of questions. There's lots of follow-up. So we'll be hearing from everybody very soon. Thank you so much.
Thank you.